All right, good morning, everyone. I see quite a number of people on here. It's good to see joining us in this cold day in Melbourne. My name's Tim Hart. I'm a director of Private Mortgages Australia, and I want to talk to you a little bit more about the type of loans that we do. But in particular, we're going to be talking about development finance because it's definitely an area of finance that the banks are, more and more sort of pulling out of or being forced to pull out of. And we're seeing it's a massive surge in private lending being used for development funding. So that's why we just wanted to cover it off because we are getting a lot more inquiries in relation to it. So just sort of broad strokes. If you guys do have any questions, there's a little chat tab. You can pop your questions in. We'll answer them at the end. If you do have something deal specific though, we'll have the details of our senior relationship manager Shanta, who you can contact if you want to talk about getting one of your clients' deals funded. So let's have a bit of a look at Private Mortgages Australia. We have 3 different products that we offer. So we do first mortgages, second mortgages, and also caveat second mortgages. So first mortgages, we have rates anything from 1 to 2.5% PCM, which is per calendar month. A lot of our loans are quite short. Probably our average loan is between your 4 to 6 month sort of mark. And we'll do anything as short as 2 months. And a long loan for us is definitely anything over 12 months, up to 3 years. So first mortgages, minimum $100,000 across the board. We'll go up to $2 million for first mortgages, up to $1 million for seconds, and $500,000 for caveat second mortgages. The next thing we'd like to sort of let our referrers know as well, what sort of loan to value ratio is. Very, very common question we get asked. I've put all of our sort of different classes of real estate that we'll lend on. Obviously today we're going to be focusing on development. So you'll see there that we break each of the postcodes into 4 different categories. So these 4 categories are based off the Genworth financial postcode categories. So Genworth being one of the major mortgage insurers in Australia. And so if you're not familiar, basically category 1 is most suburbs are in category 1. So anything usually within 40 to 50 k's of a major CBD like a Melbourne, Sydney, Brisbane is category 1. Category 2 is when you get those sort of a major regional centre, usually smaller populations. Category 3, even smaller towns. And category 4 is affectionately known in the office as whoop whoop, something that's in the middle of nowhere, might be a farm or some rural in nature. And we'll look at all 4 categories. Obviously, we'll do a lower LVR on those whoop whoop properties. So the other thing to note as well, you'll notice that as much as we've got, say, development category 1, we've got a target loan to value ratio of we'll do up to 65%. We do have discretion to go up to a maximum of 70. Okay, so private lending is all about problem solving. It's all about being a little bit flexible as well to make sure it's going to be a solution that works for you or for your client. So that's why we can go up to that slightly higher LVR if needed. Okay, so let's get straight into development finance products. So we define them as 3 broad categories. So one is your senior finance. So this is your very simple first mortgage for development purposes. We'll do terms anything usually from 12 months to 24 months, and LVRs will go up to a 70% of GRV, being gross realization value, and that obviously excludes GST. Next one is mezzanine funding, or sort of where we have a second mortgage. We sit behind the senior finance. Same sort of thing. We'll go up to a 70% of GRV. The last one is completion finance. Not a lot of even private lenders play in this market, is where the client is sort of halfway through the project and they run out of money. They hit rock or something happens and they need to raise a little bit more money towards the end. So you'll see that the term of those ones is usually only about 3 to 6 months. Now I put this little slide together here just to visually represent when they come into play. So your senior and mezz is always done at the start of the project before anything happens, whereas completion sort of comes right towards the end of the project. So what I want to go through now is just a couple of quick case studies, so you can sort of see the types of transactions that we do and why people come to Private Mortgages Australia. So the first scenario we've got is a development site in Willowvale up in Queensland. It was a land subdivision of 1 into 5. The borrower actually lived on the property. He wanted to keep his own home on one title and then sell the remaining 4 lots off. Now he'd actually pre-sold all the 4 lots, and the bank finance was unavailable due to his lack of serviceability. Something we're hearing a lot more of, where the banks get very, very stringent on serviceability. Was with private lending. Our loans a lot of time, all of the time, they're prepaid for a certain period as well. So we can structure it so there is no payments for the client, and therefore, if the client is not sort of servicing those payments, makes it a lot easier to sort of tick that box. So for us, serviceability is not an issue. We're more focused on that exit strategy of how they're going to repay the loan in full, as opposed to service it for a long period of time. So the solution for this one was the valuation came in at 2.125 million. The first mortgage that we provided was 1.475, which was a 70% LVR. The interest rate was 1.5% per month, and the loan went for 5 months. So very, very standard sort of deal for us. The next example I've got is for mezzanine finance. So this is where we'll sit second place to a first mortgagee, typically a bank. So the scenario, it was there's a development site in Glen Waverley in Victoria, and it was a 3 townhouse development. The borrower wanted to develop to keep, also known as I've got no pre-sales, and the bank finance was unavailable due to those lack of pre-sales. Okay, the bank just not comfortable with the lack of pre-sales. So the solution was we got a valuation done, and as if complete was just over $4.5 million. They already had a first mortgage with HSBC for 1.61 million, and we came in with a mezzanine finance, a second mortgage, for 1.358 million. The LVR on this deal was 64%, and the interest rate was 1.95% per month, and we did it for a 12-month period. Okay, so just same again, very, very similar to the first one, but just more we're sitting second place to a more, usually a bank, which usually have a lot cheaper funding as well. Last example we have here is a completion finance deal that we've done. It was a development site in Altona North in Victoria. It was a 3 townhouse development. They had 2 of them pre-sold. This particular one, the borrower sort of ran out of money. They were trying to self-fund the development and sort of got towards the end and just ran out of money. But the actual building was 90% complete. So the bank finance was unavailable for a myriad of reasons, but one of the big ones was lack of experience. Okay, so this was their first development project that they'd done. Another big one for a lot of lenders is they don't like lending on incomplete security. They're happy to lend before construction starts, and they're happy to lend when it's all finished, but it's all a bit icky for them in the middle. Okay, so that was a big thing of why they couldn't get finance anywhere else, is that incomplete security. And the last one was lack of serviceability. Same again, they didn't have financials up to date, and they couldn't prove serviceability for it. So the valuation came in at 1.95 million. They already had a first mortgage with Latrobe for 520 grand. We provided completion finance, a second mortgage, for 435,000. The LVR was quite low on this one, 49%. And the interest rate was 1.9%, and it was just a 2-month loan. Okay, so typically the shorter period that the client wants the funds for, the more expensive the interest rate will be, and vice versa. If they want a longer term loan, then the loan will be more expensive than the shorter one. So let's have a look at some of the fees and charges, because with PMA we're very big on it's not all about the interest rate. You especially if you're comparing different loan opportunities, we really encourage people to get their clients to assess the total cost of the loan. Okay, it's not just the interest rate. Okay, we need to look at how much the upfront fees and costs are as well, and take that into consideration. So here we've got an approval fee. So depending on the loan amount, it gets a little bit cheaper as the loan amount gets a little bit larger. And on the right-hand side there, you can see we pay a referral fee. So this is what we pay to you as the referrer, and that's included in the approval fee. Okay, so it doesn't matter if your client comes to us directly or they come through you, they pay the exact same fee. So that's when we say the referral fees are channel agnostic. It's just a real wanky way of saying it doesn't matter how they come in, they're not going to get a better deal by not going through it yourself. So that's what we charge if the loan proceeds. The only thing we charge up front is a small assessment fee. So that's usually between $550 and $770. And this is just to cover our costs of doing title search and credit checks and those sort of things. We do a lot of desktop valuations. And if we require a valuation, it's always done at cost, and same with any legal fees that we charge. Okay, so to draw up all the paperwork, it's always done at cost. We make no margin whatsoever on that. The other way that we work with referrers, obviously we've just mentioned the referral fee we have in there included as part of the approval fee, but we also allow our referrers to nominate a referrer service fee or mandate the client directly. Okay, so let's say it was a $1 million deal and you were going to get, say, 1% referral fee, but because maybe it was a development deal and there was a lot of work involved, you might charge a service fee of $1,000, $2,000, whatever it is for that particular type of transaction. So you just nominate what that amount is and we put it into our letter of offer for you. The other thing that we do for referrers, and I don't really know any other player in the market that does this, is we pay subsequent referral fees even if the client comes direct. Okay, so if you refer John Smith to us and he does a loan and then he has a great experience, he comes back and they want to borrow again, but instead of going through you as the referrer, he comes to us directly. We will do all the work and we'll fund the new loan, but we'll actually still pay you the referral fee, okay? Because it's acknowledging that where the client came from and that your client, okay? The only circumstances where we wouldn't pay a subsequent referral fee is if that John Smith went to another referrer who referred it to us. Okay, so we're only ever going to pay one referrer, but it's just I suppose just some acknowledgement of where the client came from, and that if they do come direct, you're still going to get paid, and obviously we'll keep you updated when that happens as well. But it's always a lot of fun for us, to be able to call up one of our referrers and say, hey, send us an invoice for $5,000 for a deal they did no work on. Okay, it's always a nice phone call for the referrer. So it's just another way that we reward our referrers. The final way that we do reward our referrers is the Referrer Rewards Program. And so what we do is basically just as a bit of an added bonus is as you hit key milestones, we send you a gift card. Okay, and this is a gift card of your choice. So, it could be Dan Murphy's, could be Myers, could be whatever you like, Coles Myer. And as you hit different milestones. So the other thing that's worth mentioning is that it is cumulative. So let's say the first loan that you settled with Private Mortgages Australia was a $2 million loan. You'd get a $1,000 gift card, plus you get the $500, plus you get the $250. Okay, so can add up a little bit, and just another little bonus for our referrers. As soon as you get to the $3 million mark, you enter sort of what we call PMA's Platinum Playground, where basically provided you get at least $500,000 settled each year, you'll always get a $500 gift card. So it's just rewarding those regular referrers we have year in, year out. All right, the last thing I want to sort of go through now is just to let you know about our process. Because with private lending, it is all about speed. As much as people are borrowing for the short term and they can't get bank funding, most of the time it's because we can actually turn around a loan very, very quickly. For us, we're talking about a week or two. We're not talking 6 to 8 weeks plus that a bank is going to take. Pretty much usually, if we require a valuation, that's usually the only thing that means that the process can take a little bit longer. But our process is the borrower, or you as the referrer, would submit an application form or a quick app. Now, our quick app is literally 2 pages. Okay, we just want to know the very high level detail about the transaction so that we can do our initial assessment. We then come back to you with an indicative letter of offer. In that indicative letter of offer, it will have the indicative interest rate and LVR, and it's only at that point that the client will pay the assessment fee. As soon as the assessment fee is paid, we complete our due diligence. We then issue the formal letter of offer before we then proceed to settlement. Okay, so it's designed to streamline the process and basically get an indicative letter of offer and then obviously a letter of offer out to your client as quickly as possible. Now, I also just want to cover off on how we qualify a deal. So we call this sort of our first filter. And the reason we like to let our referrers know this is so that you can almost qualify your own deal before you send it through to us. Because the last thing we want is for you to waste your time filling in, even a 2-pager if it doesn't sort of fit this first filter. So the very, very first filter is non-coded. Okay, so at Private Mortgages Australia, we only do non-coded lending, so business lending. So the purpose of the loan has to be for a business purpose. So, a developer's a great example. They've got an established development company and they're doing another project. Great, we can lend to them. As soon as the borrowing entity is a company, it's automatically deemed to be non-coded. Okay, so that just makes it nice and simple. If you do have clients that have got property in their own name, that's where we need to make sure that more than 50% of the funds are used for a business purpose. Okay, so we can't do anyone's own home, or if someone wants to go on holiday or whatever it is, it has to be for business purposes. The next one is the interest rate. The minimum rate that we do is 1% per month. Okay, and that's based on the speed that we're getting, and also that we're raising money from private individuals. So that the rate is never going to be less than 1% per month. So you just need to make sure that the client's willing to accept that. They're not expecting to get a 4, 5, 6% per annum interest rate. The next one is the postcode and LVR, or loan to value ratio. So that table that I showed you at the start, we just want to make sure that it fits within that. So your client's not trying to get a 70% LVR on a category 4 property that's in the middle of nowhere. That it's in the realms of reality. The next one is the referrer service fee or mandate. So right up front, we want to know what you want to make out of the transaction. That way we can make sure we put it into the letter of offer. Okay, the last thing we want is it to be rushed in at the last minute. Okay, for us it's all about transparency and really knowing that everyone knows exactly what's going on and who's getting paid, and it's all agreed up front before we proceed. The next one, which is very, very important to us, is the exit strategy. This is all about, comes back to setting the client up for success. If they're going to have a loan that's going to go, maybe for 4 months with us, we want to know how are they going to repay it at the end of the 4 months. What's their exit strategy? It might be the sale of a property. It might be the pre-sales being triggered. It might be a refinance. It might be money coming in from elsewhere. We just need to really make sure that is nice and solid so the client doesn't get into trouble. The other thing we do as well is with all of our loans, they come with extension periods. So normally we'll offer 3 months worth of extensions. So that way, that if the client does get to the end of the period, they can just pay 1 month's interest to extend the facility if they've had a few delays. The other thing we've got there is serviceability is not required, which I mentioned earlier as well, and is a huge reason why we do get a lot of business coming in, is we're not hamstrung like the banks are needing to have serviceability because the loan is prepaid. Okay, so it's designed to be a short-term, more of an asset lend rather than relying on the serviceability of the borrower. Next one is, why can't the client get bank finance? Now this might sound a little strange question, but very important to us, because if the client can get bank finance, don't come to us. We're never going to be cheaper than a bank. We are going to be a lot more flexible and a lot quicker, but we just want to understand what are the reasons why they can't get bank funding. So that's sort of what we can work around and make sure that we can actually do the transaction. And the last one is, when does the client need to settle? Okay, it's about working with the client to come up with a solution that's going to suit them. So if they need to settle in a week, tell us what day, so we can actually make sure that we're actually going to hit that deadline, rather than a bank that just sort of puts it into the system and when it's ready, it's ready. We're very much on the other end of it's more of a personalized service to get the client the funding when they need it. So here's just a couple of areas that we do specialise in. Obviously, we've covered development finance in this webinar. A lot of it comes down to urgent funding. Someone that can't wait the 4 to 6 weeks that a bank's going to take. And at the moment, we're seeing obviously a lot longer than that for most of the banks. We do a lot of asset lending for clients who can't show serviceability. We've also done a little bit of ATO debts. You don't have to read too many papers at the moment to see that the ATO is very much clamping down on small business, and they're not being very flexible and basically putting either the company into administration over ATO debts. And then a lot of the banks won't lend to a client if they've got an ATO debt. So they're sort of they're sort of stuck. Whereas what we can do is come in and we're happy to pay out ATO debts, which often gives that client the ability then to go to a more traditional bank and say, hey, I have no ATO debts anymore. Can you refinance my loan and cash me out? So that's something we can look at. Another big one is refinancing existing caveat loans. So some people might go and get a short-term caveat loan, and that might only go for a couple of months. It then goes into default. We saw one the other day that the client was paying 15% a month on this caveat loan, and so they were coming for us to refinance it, back down to, so I think it was below 2% a month. So it's going to be a lot cheaper for them. So that's some of the things we do. Another one is valuation not contract. So we've done loans where it's been 110, 113% LVR. Based on the contract, okay? Because we're happy to take the higher of valuation or contract price, whereas obviously all the banks will take the lower of contract or valuation. Other ones, we've got people paying out business partners, urgent business opportunities, and the last one that's worth mentioning is credit impaired, okay? Because we're more interested in the asset than the borrower themselves. Credit issues aren't an issue for us. The only time credit would be an issue is if the client is exit strategy, so how they're going to repay us is they want to refinance. Well, then we want to know that their credit is not so bad that they can't go and get a normal loan. Okay, so we want to make sure that they've got a reasonable chance of actually getting that funding at the end of the day. Okay, just to finish up, we just want to go through basically the PMA way. For us, our sort of tagline is cleaner loans, better results. So for us, it's all about transparency, letting the client know exactly what the costs are. So we have low upfront assessment fees. That's the only thing we charge upfront. We saw one the other day. I think they charged an $18,000 upfront fee, and if the loan didn't proceed, then the client lost the $18,000. For us, it's $550. It's more of a cost recovery exercise for us. We also have no charging clauses in our indicative letter of offer and no cancellation fees. So the client can sign that. If it doesn't proceed or they change their mind, there's nothing else they need to pay. Valuations, as we mentioned, are done at cost. The other thing that's worth mentioning is that we do them for a reasonable value. So we'll do it for mortgagee purposes or for market value purposes. We have seen the marketplace, other lenders, they'll get a valuation, but they'll do it for forced sale, which is basically telling the valuer, put a really low value on this, often 10, 20% under market value. And obviously that makes a massive impact on the LVR that the client can then get. Any legal fees are done at cost. We also have capped interest rate ranges. So our first mortgages are going to be between 1% and 2.5% per month. We're not going to suddenly come back with an offer. It's going to be 5% a month or anything like that. The other thing we do, we rebate any unused interest on extension payments. So if your client gets to the end of the term, they make a 1 month payment to extend the facility, but then they settle 2 weeks later, we'll refund the interest that they didn't use. Okay, the only interest that we don't refund is the prepaid loan term. So if they've got a prepaid loan for 3 months, if they pay it out, they win the lotto and pay it back after 1 day, well, they're still going to pay the interest for the 3 months, because that's sort of the minimum amount of interest that we need to make it worth our while. We also have custom-built software for faster deal processing times. So we've spent a phenomenal amount of money building our own software. and it all comes back to being the fastest in the industry in terms of our processing times. So that really helps us process things faster, which in turn means we have more and more happy clients. Something we're very proud of, we have a high level of repeat customers. So people, especially people in that development space as well, that they want to go on to the next project and the next project, that they've had a good experience with us and they want to lend again and again. Okay, and that's what we're all about. We're here for the long term, and it's all about a win-win approach to lending. So if you guys have any questions, scenarios, things you want to run past us, please contact Shanta, and she'll be able to look after you. We've got her direct number there, as well as her email address. Also, feel free to check out our website, privatemortgagesaustralia.com.au. We've got quite an extensive resources section for referrers. So we've got 15 different training videos on there. So talking about all different types of things with private lending and how it works. And of course, we're on all the social pages as well. So yeah, please drop us a line. We do look forward to hearing from you, and hopefully hearing about some deals that you've got coming up. So guys, thank you. I will keep it there. I'll keep it brief, but thank you for attending, and we look forward to hearing from you soon. Thanks. Bye.